Welcome to the Deep Dive, the show where we really try to cut through the noise and,
Yeah.
get straight to the insights you need to be genuinely well-informed.
That's the goal.
Today, we're pulling back the curtain on a headline that, look, at first glance, it might seem pretty contained, just a regional thing. Hong Kong banks just shocked the world. But believe me, what's unfolding over there is way more than just a local financial blip. It feels like a critical early warning signal for the entire global economy.
It really does.
We're talking about whispers, informal talks apparently, about a bad bank, one of those entities designed to basically gobble up toxic debt.
Right. And, maybe even more tellingly, the startling reappearance of this 26-year-old crisis letter, a relic, really, from the Asian financial meltdown back in '98.
Yeah, and what's really fascinating here, I think, is that our insights today, they're not just coming from the usual mainstream financial news outlets. We've actually taken excerpts from a Eurodollar University YouTube transcript.
Ah, okay. Known for a different perspective. Exactly. A source known for its deep, sometimes unconventional dives into global liquidity, the plumbing of the monetary system, really. And this source meticulously details the profound concerns that are now bubbling up within Hong Kong's banking system. It offers a perspective that, frankly, challenges a lot of the prevailing assumptions you might hear elsewhere.
So it's not just a passing blip.
No, definitely not. It's a symptom of much deeper systemic issues that are really at play here.
Okay, good. So our mission today is to go far beyond that initial headline, beyond the surface stuff. We're not just uncovering what is happening in Hong Kong, but really digging into why it matters directly to you wherever you happen to be listening. Because this isn't just a Hong Kong story, is it? It feels like a powerful cautionary tale, one that reveals these bigger global economic realities and maybe sheds a pretty harsh light on what we're calling the financial world's pervasive extend and pretend paradigm.
Absolutely. We're aiming for those aha moments, the ones that connect these seemingly distant events, like a bank problem in Hong Kong, to the fundamental assumptions everyone, including policymakers, investors, maybe even you, has been operating on about the global economy. Assumptions that are now being, severely tested.
Right. So let's unpack this. Let's really try and understand the sort of seismic shifts that seem to be underway.
Yeah.
Okay, let's start with what's making the biggest waves right now in Hong Kong. These very serious alarms ringing in their banking sector.
Right.
And the first major red flag that really caught our attention, these informal but apparently highly significant discussions about forming a bad bank.
Yeah.
Now, for listeners maybe less familiar, what exactly is a bad bank in this context? And why is just the discussion of it such an immediate, flashing signal of distress?
Well, the term bad bank here, it refers to pretty much exactly what it sounds like. It's an entity, often government-backed or industry-funded, specifically designed to essentially isolate and store an increasingly unmanageable pile of what are called soured loans or non-performing loans, NPLs for short.
Right, the ones that aren't getting paid back.
Exactly. Loans that aren't being repaid as expected or are at really high risk of default. You can sort of think of it like a financial hospital ward, maybe, just for the really sick assets. Bloomberg recently reported on these preliminary talks happening among some of Hong Kong's biggest, most influential bankers.
Top tier guys.
Top tier. And the purpose, quite simply, would be to try and soak up the financial hub's sour debt, particularly debt coming from its, frankly, beleaguered property sector right now.
And when the top bankers, the very people whose job it is to project confidence and stability, start having even informal chats about creating something like a bad bank, that's just never a good sign, is it? It feels like a huge admission of, profound systemic weakness.
It's absolutely never a good sign. The very fact that these conversations are even occurring, that they've leaked out, signifies a deep, pervasive concern right within the banking establishment itself. It's basically an implicit acknowledgement that their existing pile of bad loans has become too big, too problematic to realistically manage within their normal balance sheets.
Can't handle it anymore.
They can't. They see a serious risk of these loans escalating, maybe triggering wider defaults, and creating these cascading destructive problems throughout the whole financial system if they're just left unaddressed on the main books. Now, Bloomberg did note these talks are still preliminary, significant hurdles exist before they could actually implement something like this.
Sure. Lots of politics involved, I imagine.
Oh, tons. But the crucial point, the real red flag here, is that these conversations are happening at all. It tells you the situation situation internally has gotten that bad. Historically, bad banks are really a measure of last resort. They're typically only considered during or immediately after major financial crises.
Like the S&L crisis or '08.
Exactly. The savings and loan crisis in the U.S. back in the 80s, the Asian financial crisis itself in the late 90s, or the global financial crisis of 2008, their very consideration just speaks volumes about the perceived depth of the problem they think they're facing.
So why now? I mean, why are these discussions surfacing specifically at this moment, mid-2025? It feels like everyone was hoping things would be getting better by now. What's the immediate catalyst for this urgency?
Well, I think it's because the harsh realization has finally sunk in. The reality check is that the situation isn't just not improving. It's actually not expected to become more favorable in 2025 either. This is contrary to what so many had hoped and, frankly, publicly stated over the last year or so.
Right, the whole soft landing narrative.
Exactly. There was this widespread belief, almost an article of faith, that the global economy was on the cusp of this magical soft landing where, central banks would tweak interest rates just right, bring inflation down without choking off growth entirely. But that mythical scenario, well, it just hasn't materialized. It's nowhere in sight.
And the loan numbers reflect this reality setting in.
They do, at least the published ones. The published non-performing loan levels in Hong Kong currently stand at about 25 billion Hong Kong dollars. That was as of the first quarter of this year. Now, that translates to a reported bad debt rate of roughly 2%.
Okay, 2%. That maybe doesn't sound catastrophic on its own, but I imagine, like you said, the official figures might not fully capture the underlying reality, especially in system facing this kind of stress, right? There's always that hidden story behind the numbers.
Precisely. That's the published number.
Right.
And in the context of these kinds of discussions, talks about a bad bank, it almost always implies that the real number, the one they're truly worried about behind closed doors, is likely much higher and significantly worse. And rating agencies are actually confirming this unspoken fear. Fitch Ratings, for example, they expect the official NPL rate to rise to around 2.3% this year. Now, okay, maybe that doesn't sound dramatically different from 2%, but it's worth noting that even that figure is already, quote, off the worst level in the entire Asia-Pacific region. So context matters.
Not a great league table to be near the top of.
Not at all, and it doesn't stop there. Fitch also anticipates that asset quality will, and I quote again, continue to deteriorate into 2026 and maybe even beyond. So they're not seeing a turnaround anytime soon.
Wow.
They've clearly given a deteriorating sector outlook for Hong Kong banks, specifically for 2025. They anticipate, quote, earnings pressure from reduced net interest margins, which is basically the profit banks make from lending versus deposits, likely due to expectations of lower interest rates ahead.
So less profit buffer.
Less buffer, exactly. And critically, they point to lingering asset quality risk stemming directly from local commercial real estate exposures. Vacancy rates remain stubbornly elevated. There are fewer businesses renting offices, storefronts. That puts more pressure on the landlords.
And therefore the banks that lent to them.
And by extension, the banks. It creates this vicious cycle, Declining rental income makes it harder for borrowers to repay their loans, which leads inevitably to more sour loans hitting the bank's books. It's a feedback loop.
Okay, so not only are Hong Kong's top bankers talking about creating a bad bank for these sour loans, which is a massive red flag in itself, but then we have this other truly intriguing development. The startling reappearance of that 26-year-old document. It's almost like, a ghost from a past crisis coming back to haunt the present. Tell us about this crisis letter resurfacing.
Yeah, this is really significant, I think, and deeply symbolic. It's the recirculation of a document from way back in April 1998, known formally as the Hong Kong Approach to Corporate Difficulties. Now, this wasn't just some, dusty old internal memo. It was specifically developed by the Hong Kong Monetary Authority, the HKMA, their central bank equivalent, during the absolute depths of the brutal 1998 Asian meltdown.
Right in the thick of it.
Right in the thick of it. Its original purpose was explicitly to guide the banking sector through that severe crisis, help them avoid repeating catastrophic mistakes, like pulling credit lines too fast, which could lead to widespread insolvencies and potentially a complete collapse of the financial system.
And someone pointed out its significance now.
Yeah, a hedge fund executive was quoted, putting it quite starkly. He said, basically, whenever this specific document starts making the rounds, it often means that lenders are bracing for or already confronting a wave of corporate distress.
Wow, so it's like their internal bat signal for trouble.
Pretty much. It's their internal alarm bell, a clear signal that the financial landscape is seen as deteriorating and deteriorating rapidly.
Okay, so what are the core guidelines? What does this letter actually say that makes it so relevant, maybe even urgent, right now, over 2 decades later?
Well, its core guidelines are quite specific, but they tell this broader cautionary tale about how financial systems can, well, unravel if panic sets in. The letter states, and this is key, that banks' initial attitude toward financially troubled borrowers should be one of support.
Support, not immediate crackdown.
Exactly. They should not withdraw facilities or hastily put the borrower into receivership or issue writs demanding repayment. In other words, that knee-jerk reaction, tightening credit, immediately seizing assets, which often just compounds a crisis, is explicitly warned against.
Okay.
Instead, the letter says banks should try to ensure the borrower has sufficient liquidity to continue trading, basically keep the lights on, until a considered view of its prospects can be reached. Let things calm down, get the facts.
Makes sense.
And it stresses that decisions should only be made based on reliable information that's shared fully with all the banks involved. It encourages cooperation. And borrowers, in turn, have a responsibility to make their affairs wholly available to those banks. Transparency is key.
So the underlying message is stay calm, work together.
It's a desperate plea, really, for a coordinated, calm, and patient approach to distress, rather than that frantic, every bank for itself scramble that could easily trigger a much wider collapse.
It sounds like it's urging this calm, measured, almost cooperative approach among the banks. Is this essentially what some people might call extend and pretend, just sort of formalized?
Yeah.
Or is it fundamentally different from that?
That's a really crucial distinction to make. While it definitely advocates patience, it's not strictly extend and pretend in the, let's say, the negative or malicious sense of just hiding problems indefinitely. Nor is it really designed to completely eliminate price discovery, finding the true market value.
Yeah.
Its underlying intent, as written back in '98, seems to be more about urging patience and consideration, meaning that any transactions that do occur or any restructuring efforts should try to reflect the underlying fundamental economics of a deal, rather than simply reacting to the immediate level of distress and forcing these desperate fire sales at rock-bottom prices.
So avoid panic selling that crashes the whole market.
Exactly. It's about staying calm and collected, avoiding those emotional or overly urgent actions that could trigger a cascading crisis across the entire economy. The document basically says, look, do everything you reasonably can not to just indiscriminately foreclose on properties or force bankruptcies that lead to widespread distress and these forced undervalued sales.
So manage the problem. Don't ignite it.
Precisely. It's about managing what might be an inevitable problem, but with a view toward long-term stability, rather than just opting for that short-term liquidation, which could absolutely devastate the entire system.
So if this document is normally only seen during these extreme crisis periods, you mentioned 2008, the global financial crisis, maybe even during the height of the 2019 protests in Hong Kong, or the immediate shock of 2020 lockdowns, its current recirculation now, alongside these rumored talks of a bad bank, I mean, that implies a truly significant escalation in the situation, doesn't it?
It really does.
It means things have reached a critical juncture, something far beyond just a typical cyclical downturn.
Precisely. Its reappearance now, especially when, as we said, so many were hoping for a global recovery or at least stabilization, strongly suggests that Hong Kong is, quote, finally reaching a decision point. It indicates that the previous strategies, maybe the quieter ways of managing underlying issues, perhaps hoping things would just improve on their own, those are no longer seen as sufficient.
The quiet hope phase is over.
It seems so. The financial system isn't just bracing for significant corporate distress anymore. It appears to be actively confronting it. It's a sign that the quiet struggles, the papering over the cracks perhaps of the past few years, are now demanding a loud, public, and potentially quite painful reckoning.
Right.
And that calm, collective approach this letter advocates, well, it's now being put to the ultimate test in an environment that feels anything but calm right now.
Okay. This brings us neatly to a crucial point that really goes beyond Hong Kong itself. It gets to what we're calling this global extend and pretend paradigm. You mentioned earlier that what's happening there isn't isolated. It's about these fundamental assumptions everyone has been operating on. Let's really dig into this idea of the price illusion and this notion of an economy that somehow forgot how to grow.
Yeah, this is where it gets really interesting, I think, and where the Hong Kong story becomes, like you said, a microcosm of a much larger global malaise. You have to back a bit. After the lockdowns ended back in 2020 and 2021, Almost everyone, and I really mean almost everyone, including some of the smartest, most accomplished people in global finance, central bankers, top analysts, you name it, they looked at rapidly rising consumer price rates, CPI inflation,
Yeah, headline inflation was spiking.
spiking, and they viewed it as an unambiguous sign of a red-hot global economy, maybe even an overheating economy. They genuinely believed this surge in demand and prices would last, that it signaled robust underlying growth finally returning.
Which sounds now like a pretty fundamental misdiagnosis, like focusing on just one symptom, the fever, without understanding the underlying disease, maybe.
That's a perfect analogy. It really was. It was what our source material calls a price illusion. It was fundamentally a supply and demand imbalance, yes, but critically, it occurred within a much lower, much more fundamentally weakened global economic state.
Oh, wow.
The global economy had, in effect, forgot how to grow in a sustainable, productive way after the shocks of 2008 and then the pandemic. So using your analogy, think of it like a patient who suddenly develops a high fever.
Right.
Instead of recognizing the fever as a potential sign of illness, maybe a deep underlying infection, the doctors, in this case the economists and policymakers, concluded the patient must be experiencing a burst of healthy energy and robust metabolism simply because of the heat.
When really they were sick.
Exactly. Everyone thought the heat meant recovery was underway, but it was actually just a symptom of profound systemic illness, largely driven by supply shocks and massive liquidity injections, not genuine economic vitality. And this fundamental misdiagnosis, this confusion of temporary supply shocks and artificial stimulus with robust economic growth, is precisely, as the source puts it, where this banking and bubble bust cycle originated.
Because money flowed based on that wrong assumption.
Money was pumped in, policies were set, investments were made, all based on the idea of an overheating economy that needed cooling, when in reality, the real productive capacity just wasn't there to absorb it healthfully. It led mainly to asset price inflation, masking a fundamental lack of genuine economic expansion.
And then after that initial mistake, when the fever of inflation maybe proved to be less about overheating and more about, well, dysfunction, the hope shifted, didn't it? There was this widespread belief, this narrative, that maybe lower interest rates, or at least stable rates engineered by central banks, would somehow lead to this benign soft landing in 2024 or maybe 2025.
Yeah, the pivot narrative.
Right, that somehow we'd get this magical cushion, this period of favorable conditions that would allow everyone to absorb all the previous mistakes and misdiagnoses without any real pain. Just glide down smoothly.
Yes, that was essentially the second major macroeconomic mistake, or perhaps hope, piled onto the first one, believing that simply adjusting interest rates, as if central banks have these precise levers that unilaterally control the entirety of complex global economic activity, would somehow engineer this smooth, soft landing.
Which always sounded a bit too good to be true.
It did. And the problem is this mythical soft landing recovery never showed up.
Yeah.
It just didn't happen. We are now, in mid-2025, moving further and further away from that hoped-for Goldilocks scenario.
So Goldilocks is what, running late?
Goldilocks arrival. You know, the idea of an economy that's just right, not too hot with inflation, not too cold with recession. It isn't just postponed, she's been canceled. The invitation has been withdrawn. There's really no longer a credible expectation, I think, of some benign environment where all these accumulated financial issues, these bad debts, these distortions can just resolve themselves quietly in the background.
And that's why the urgency is increasing now.
That's exactly why. As a direct result, the widespread policy, or maybe habit, of extend and pretend is now visibly giving way to urgency and growing system worries, because that window, that hope for a painless resolution, is rapidly closing. Or perhaps it's already slammed shut.
Okay, let's define this extend and pretend paradigm more clearly then. It's not just a casual phrase. It sounds like it's been a core operational philosophy, maybe implicitly, in the financial world for a while now. One that has these profound consequences we're starting to see.
It absolutely is. Extend and pretend. You can think of it as the direct financial equivalent of that forgot how to grow economy we talked about. It means deliberately, actively delaying price discovery.
Okay, what's price discovery again, simply?
It's just the process of finding out what something is really worth in the market right now. So delaying price discovery means delaying the moment when The true underlying value of assets, especially the bad ones, the sour loans, the overvalued properties, is revealed and crucially written down on the books, acknowledging the loss.
Got it.
So you hold off on acknowledging those losses. You roll over the loan, you amend the terms, you hope that more favorable terms or the magical appearance of Goldilocks and a booming economy will somehow materialize down the line. You hope this allows these bad debts to eventually be offloaded or resolved with minimal or ideally zero consequences for the lender.
It's basically just kicking the can down the road, isn't it? Hoping the problem magically disappears before you trip over the can.
That's a perfect way to put it. It is the financial equivalent of just kicking the can down the road, hoping the problem will vanish or shrink, rather than facing the mess head on when it might be more manageable. Or, let me try another metaphor.
Okay.
Imagine you have an old house, right? And you know it has these deep structural cracks in the foundation. Real problems. Extend and pretend isn't about actually fixing those cracks, doing the hard, expensive work. It's about just putting up some fresh drywall, slapping on a new coat of paint right over them, hoping nobody looks too closely, and just praying that a strong wind or maybe a small tremor doesn't cause the whole thing to crumble.
You're hiding the problem, not solving it.
Exactly. You're compounding the initial error, the structural weakness, with another error, concealment, and delay. You're just delaying the inevitable and allowing the underlying rot, the bad debt, the misallocation to fester and potentially grow much larger and more dangerous.
Okay, can you give us some concrete examples of where this extend and pretend philosophy has been visibly happening, not just in the abstract?
Absolutely. We see it playing out very clearly in Hong Kong, which is our focus today. Banks there have reportedly been systematically rolling over loans backed by real estate, particularly commercial real estate, and amending the original terms specifically to avoid triggering write-downs or defaults.
Keeping the loans performing on paper.
Precisely. This deliberate delay in recognizing impairments has, according to analysts like Jason Bedford, a former UBS bank analyst who specialized in the region, helped mask even weaker underlying asset quality. He was quoted saying something like, "We should be seeing more distressed sales. It's a little alarming that we're not."
The lack of sales is the signal.
Yes. The absence of those forced distressed sales indicates that the true lower market value of these assets isn't being acknowledged or realized. The can is being kicked. But look, this dynamic isn't unique to Hong Kong at all. It's prevalent in other major markets too. Think about U.S. commercial real estate right now, big concerns there.
Yeah.
Or even U.S. corporate credit markets, where many so-called zombie companies.
Oh, yeah, the zombies.
Firms that are just barely profitable enough to pay the interest on their debt, but nowhere near enough to actually pay down the principal or invest. They're being kept alive artificially through successive rounds of refinancing, often on hope-based assumptions rather than solid fundamentals. Extend and pretend inaction.
And then there's China, which looms so large over Hong Kong. There's this pervasive belief, certainly a year or two ago, that the bazooka from Beijing, massive fiscal spending, stimulus measures, would somehow stabilize the whole situation, particularly in Hong Kong, which is so closely linked, almost a derivative of the Chinese economy. But your source material suggests the stimulus hasn't really worked as hoped, has it? It feels like maybe just another layer of extend and pretend on a national scale.
You're absolutely right to bring that up. That bazooka from Beijing, which was launched with considerable fanfare almost an entire year ago now, promising revitalization, well, the verdict seems to be. It has changed nothing fundamental and has nothing to show for it in terms of kickstarting a sustainable, broad-based recovery.
Nothing.
Well, not nothing, but nothing sustainable. Despite all the efforts, all the liquidity nudges, mainland Chinese banks are reportedly still not lending at the levels needed for a robust recovery. They're cautious, maybe worried about their own balance sheets, and the broader Chinese economy, despite official GDP numbers, just isn't truly picking up organic steam.
So where is the activity coming from then?
That's the key. We only really see activity pick up noticeably in certain sectors when, as the source puts it, Beijing is picking up the tab directly. Like, remember the temporary bump in retail sales we saw back in May?
Yeah, there was some positive data.
Right, but that was heavily influenced by direct government subsidies, particularly for things like new electric vehicle purchases. Car sales jumped. But crucially, once those subsidies ended or phased out, what happened in June, retail sales actually dropped back into negative territory again.
Unsustainable. A sugar high.
Exactly. It highlights the fundamental unsustainability of the so-called recovery. It's not self-generating. And this is the real danger of extend and pretend on any scale. It relies on avoiding price discovery, the true price, the true value of assets, the true underlying economic health. That becomes the enemy of extend and pretend because revealing it would force a painful reckoning, force loss recognition.
And makes the problem bigger over time.
It allows a situation that, frankly, would have been more easily handled back in the past, maybe a few years ago, before it got to be truly out of control, to just fester and grow into potentially an overwhelming systemic problem.
Okay, this brings us to a really fascinating case study you mentioned earlier, one that seems to highlight this growing urgency, maybe the point where extend and pretend starts hitting its absolute limits. The situation with the Hong Kong New World Group. What exactly happened there, and what does it tell us about the broader, maybe deteriorating situation within Hong Kong's financial system right now?
Yeah, the New World Group situation is really telling. They're one of Hong Kong's major, long-established conglomerates, huge holdings in property development, infrastructure, retail, hotels, a big player. Last month, they apparently faced what was described bluntly as a huge liquidity wall, an insurmountable amount of debt coming due.
How much are we talking?
We're talking a staggering HKD 63 billion, that's roughly USD 8 billion in borrowings that were due this year alone, just an immense amount. And everybody knew, analysts, bankers, likely the company itself, knew this was an impossibility for them to somehow repay just from their existing cash flow or by selling assets, especially not in a downturn sluggish property market where buyers are scarce.
So the choice was stark.
Extremely stark. It was basically either a massive, messy insolvency, a default, or some kind of collective, almost desperate effort by the banks to keep the firm afloat just a little longer. And the stakes were huge. Had New World defaulted on that kind of scale, it almost certainly would have sent the already edgy Hong Kong money and financial markets into a full-on tailspin.
Contagion risk.
Massive contagion risk. The reverberations would have been enormous, potentially triggering a chain reaction across the entire financial system. So what happened? In a pretty dramatic effort, Hong Kong's city banks, the big local players and maybe some international ones too, came together to construct this massive syndicated loan rescue package, a huge new loan essentially, to pay off the old loans.
So consistent with that crisis letter approach.
Exactly. It was an arrangement perfectly consistent with the spirit, if not the exact letter, of that very Hong Kong approach to corporate difficulties letter we just discussed. A coordinated effort, banks working together, however reluctantly, to prevent a potential systemic collapse.
Okay, but was this rescue smooth? I mean, did it just happen easily given how high the stakes were? Or was it more of a frantic, last-ditch kind of effort?
Oh, far from smooth. Reports suggest this was not some easy, orderly operation at all. It reportedly took until the absolute last minute, like down to the wire, for the consortium of over 50 banks involved, that's a huge syndicate, to coordinate, to work out all the intricate details, the terms, the collateral, and actually commit their funds.
50 banks agreeing on anything sounds hard.
Extremely hard, especially when they're all worried about their own risk. It was described by sources as almost a last minute, just in the nick of time completion. Literally days or hours before disaster potentially struck.
Wow. And if it hadn't gone through?
Had it not gone through, had even a few of those 50-plus banks wavered at the last second, some of New World's key collateral prime assets likely would have been encumbered or even seized by individual creditors scrambling to get paid. That would have made any further rescue attempts virtually impossible and likely would have condemned the firm to a chaotic breakup or bankruptcy.
Sounds a bit like LTCM back in the day.
The parallel is definitely there. The source material specifically mentions it was chillingly akin to the long-term capital management LTCM situation back in the late 90s in the U.S. Remember that? A massive, highly leveraged hedge fund's sudden collapse threatened to bring down the entire global financial system, forcing rival investment banks, orchestrated by the Fed, to cooperate in a bailout purely out of self-preservation to avoid collective suffering.
The shotgun wedding, basically.
Pretty much. And this extremely difficult, is very near-miss experience with New World just last month is almost certainly a major driving force behind these current informal talks about establishing a bad bank and the urgent recirculation of that 1998 crisis letter. It represents a substantial escalation in the perceived fragility of banking system conditions right now in mid-2025, precisely when the global narrative was supposed to be about recovery and improvement.
So it's a huge wake-up call.
A massive wake-up call that the old extend and pretend playbook might be reaching its breaking point. The problems are becoming too big to just paper over quietly anymore.
Okay, so we've got these internal banking alarms ringing loudly. We've got the resurfacing of this crisis document from decades past, and we've got this last-minute nail-biting rescue of a major corporation. Now let's talk about something really tangible, something the markets themselves are reflecting in real time: the dramatic plunge of the Hong Kong dollar. This feels like more than just a technical financial maneuver or some kind of trade. It feels like a profound symptom of deep systemic stress, and it's a big one.
You're absolutely right to focus on the currency. The Hong Kong dollar absolutely plunged in historic fashion during May and June of this year. And this is particularly striking because for months leading up to early May, it had actually been relentlessly strong.
Right, wasn't it hitting the strong side of its band?
Exactly. It was soaring with a whole lot of crisis emergency indications. Often unusual strength can signal stress too, like a flight to perceived safety or liquidity issues. It even hit the very upper bound, the strong side, of the HKMA's tightly controlled trading range. Now remember, the Hong Kong dollar operates under what's called a linked exchange rate system. It's pegged to the US dollar, but allowed to trade within a very narrow band, specifically between 7.75 Hong Kong dollars to 1 US dollar on the strong side and 7.85 on the weak side.
Okay, 7.75 is the ceiling.
The 7.75 is the strong side ceiling, and on May 2nd of this year, it smacked right into that ceiling.
So when the HKD hit that strong upper limit, 7.75, what did the Hong Kong Monetary Authority, the HKMA, do to maintain the peg? That's their job, right? And what was the immediate effect of their intervention?
Yes, maintaining that peg is their core mandate. So when it reached 7.75, the HKMA intervened exactly as expected under its rules. They did this by buying US dollars in the market and simultaneously selling newly created Hong Kong dollar reserves. They essentially print HK dollars to buy USD.
Injecting HKD liquidity.
Precisely. And this wasn't just some minor routine adjustment. Reports called it a record intervention in the currency markets at the time. It was a massive injection of Hong Kong dollar liquidity into the system. And the direct, immediate consequence of that action was that it flooded Hong Kong's money markets with spare funds, sending short-term money rates, specifically the overnight Hong Kong interbank offered rate, or HIBOR, plunging all the way down to zero.
Wow, zero interest rates overnight.
Basically zero. The idea is this is meant to discourage further capital inflows seeking higher rates and thus alleviate that upward pressure on the currency, pushing it back away from the strong side band. Standard central banking procedure for a peg.
Okay, sounds logical.
But here's the kicker, as they say. And this is where the story gets really compelling and concerning. Despite this record intervention, despite short-term rates plummeting to new zero as designed, the Hong Kong dollar then performed this astonishing U-turn. It went completely from the upper bound 7.75 to the lower bound 7.85, from the strongest possible level to the weakest possible level in the space of about a month. May into June.
That's a massive swing for a pig currency.
It is an enormous change, as the source material calls it, for a currency that's supposed to be tightly controlled within that narrow corridor. It's not supposed to ping-pong like that, especially not after such a huge intervention aimed at weakening it.
Now, the mainstream explanation, the one you often hear for a currency weakening like that, especially when interest rates are low, often revolves around something called a carry trade, where investors borrow in a low interest rate currency like the HKD after the intervention, and then invest that money in a higher yielding currency or asset elsewhere. Is that what's truly happening here with the Hong Kong dollar's dramatic plunge, or is something else going on?
Well, the mainstream narrative, the sort of simple go-to explanation you'll often hear from financial news outlets, is almost always carry trade. The logic seems straightforward. People are borrowing cheap Hong Kong dollars because the HKMA just pushed rates down to zero, and then they're reinvesting those funds overseas, maybe in U.S. Treasuries or something else offering a better return. That outflow, in theory, weakens the HKD. Makes sense on the surface.
But she sounds skeptical. What's the discrepancy?
The discrepancy lies in what usually happens with market rates during a true carry trade. If it really were just a carry trade in the traditional sense, you'd typically expect to see Hong Kong's own money market rates, like HIBOR, start to normalize, start to rise again as the trade takes hold. Why? Because all that borrowing activity should eventually soak up the excess liquidity and push short-term borrowing costs back up.
Supply and demand for loans.
Exactly. But that's emphatically not what we're seeing. Hong Kong's overnight HIBOR rate remains stubbornly pinned near zero. It was around 0.195%, basically nothing, as of the source report yet. Despite these rock-bottom borrowing costs, the Hong Kong dollar is stuck hard against the absolute lower bound, the weekend 7.85, of its trading range. It's showing persistent, relentless weakness.
So the cheap money isn't encouraging enough borrowing to lift rates, but the currency is still weak. What does that imply?
This severe discrepancy, the currency being weak while rates stay near zero, strongly indicates it's more of a one-way trade, meaning it's less about yield-seeking arbitrage and more likely money fleeing Hong Kong. It suggests capital outflow driven by a growing, pervasive sense of systemic risk within Hong Kong itself, rather than just investors calmly exploiting a temporary interest rate differential for a bit of extra profit.
That's a really crucial distinction, isn't it? It's not just some casual financial maneuver by hedge funds.
Yeah.
It sounds like a fundamental vote of no confidence in the stability or prospects of the system itself. It's a sign of capital flight, potentially driven more by fear than by pure financial opportunity.
Exactly. Let me try that boat analogy again. Think of a large passenger ship that everyone believed was sturdy and seaworthy, just sailing along smoothly. The carry trade explanation for the Hong Kong dollar's weakness is like saying, oh, the passengers are just casually moving from one side of the deck to the other because there's a slightly better view over there, causing the boat to list gently and temporarily. But what's really happening, when you see a sudden, persistent plunge like this, despite massive efforts by the captain, the HKMA, to stabilize the ship by flooding certain compartments, injecting liquidity, it suggests something more serious. It suggests there might be a growing fundamental leak below deck that people are becoming aware of. And maybe some passengers are quietly but urgently scrambling into the lifeboats, causing the entire boat to visibly list and settle deeper into the water, regardless of the captain's actions.
So the plunge isn't just a casual rebalancing.
No. The Hong Kong dollar's plunge, in this context, isn't just a casual rebalancing or an opportunistic trade exploiting rate differentials. It looks much more like a flight from perceived growing systemic risk. And significantly, this dramatic weakening, this reversal from strength to weakness, started happening right around the same time as that frantic, last-minute New World Rescue package was being put together.
They likely connect.
They almost certainly connect. It powerfully reinforces the severity of the underlying situation. The Hong Kong dollar is weak, and persistently so, likely because of the growing risk to the entire financial system, not because of some benign interest rate arbitrage opportunity. It's a major market signal that the financial foundations are shaking and capital is getting nervous.
Right, so this clearly isn't just an isolated incident then. What's unfolding in Hong Kong seems deeply connected to these broader, deeper global economic woes. It really makes Hong Kong feel like a critical bellwether, maybe a canary in the global coal mine for what's happening or maybe what's about to happen elsewhere around the world. You mentioned earlier that the global economic situation hasn't worked out like everyone wanted. What does that really mean for the broader financial landscape? Where did things go wrong?
Well, fundamentally, it means there was no genuine recovery after the pandemic. Despite all the official pronouncements, the V-shaped recovery hopes, and the initial market euphoria. What we actually witnessed instead were enormous bubbles and further distortions created across various asset markets, largely fueled by unprecedented central bank liquidity and government stimulus.
Right, asset prices went nuts.
Absolutely. Stocks, bonds, crypto, real estate, almost everything went up, often disconnected from underlying economic reality. And now, those bubbles and distortions are proving highly damaging as the tide of liquidity recedes and reality starts to bite. We saw massive money printing that propped up financial asset prices, yes, but the underlying real economy, the one that actually creates tangible goods, services, and sustainable jobs, struggled to truly rebound in a healthy way. It was more financial engineering than organic growth.
And the outlook now reflects that.
It does. The short-run outlook for the rest of 2025, heading into 2026, isn't just looking negative, it's looking increasingly negative, according to the analysis we're drawing on. And importantly, this isn't primarily about the latest trade tariffs or geopolitical spats, though those don't help. It's about fundamental, structural economic forces at play globally that indicate a profound lack of organic growth momentum. The world effectively created the illusion of growth through financial means, rather than fostering true, productive economic expansion. And that illusion is now fading.
And China, which has such a heavy influence on Hong Kong, its banking sector, its trade, its general economic fortune seems to be a key driver, or at least a major symptom of this increasingly negative global outlook. What specific signals are we seeing from China's economy that are contributing to this global malaise and directly impacting Hong Kong right now?
Yeah, China remains a huge factor, acting as a significant source of deflationary pressure on the global economy, which is the opposite of what everyone worried about just a year or two ago. We're consistently seeing these negative economic signals coming out of China across the board.
Like what specifically?
Well, while their recent official GDP data showed a slowdown, maybe it was slightly less severe than some extreme forecasts, but crucially, it came with another negative deflator. That's the overall price level across the entire GDP calculation. And that negative deflator actually accelerated to the downside.
So prices are falling faster.
Overall, prices are falling faster. This marks the 9th consecutive quarter, apparently, of a decline in overall Chinese GDP prices. Now, what does a negative deflator mean in simple terms? It signifies that the actual value or price of everything produced in China is, on average, declining. It's not just that prices aren't rising much, it means falling prices for goods and services across the whole economy. That's classic deflationary pressure.
Driven by what? Lack of demand.
Predominantly driven by the business sector, it seems. We see this reflected starkly in their Producer Price Index, PPI, which measures prices at the factory gate. It's been deeply negative for a long time now, whether you want to call it industrial oversupply, maybe excess capacity built up over years, or just a profound lack of both internal consumer demand and external export demand. Whatever the label, it points towards, as the source puts it, recession levels, lack of demand.
Okay, but what about all the stimulus measures? We talked about the bazooka from Beijing earlier. The world was kind of holding its breath, expecting that massive government spending and support to stabilize everything, maybe even reignite growth. Has that had any lasting positive impact at all?
Honestly, almost none in terms of changing the fundamental trajectory. That much-hyped bazooka stimulus, launched nearly a full year ago now with such high expectations, seems to have changed nothing fundamental and really has nothing to show for it in terms of generating a sustainable, self-propelling recovery.
So the banks still aren't lending.
Reports indicate mainland Chinese banks are still not lending at the levels needed to truly stimulate robust economic growth. They remain cautious, perhaps worried about their own exposure to the property sector or the overall economic outlook. And the broader Chinese economy, despite official narratives, still isn't recovering organically.
We mentioned the retail sales example.
Exactly. The only times activity really seems to pick up are when Beijing is picking up the tab directly through subsidies or government programs. We saw that temporary bump in retail sales in May, largely driven by those government incentives for things like vehicle purchases. But once those subsidies ended or faded, June retail sales reportedly dropped right back into negative territory again. It just demonstrates the fragility and the utter unsustainability of any activity that isn't market-driven.
So, looking ahead for China and its impact.
It looks like all of the risks are on the downside. China's immense internal debt overhang, its deeply troubled property market, which hasn't found a bottom, and persistently flagging consumer confidence. All these factors are acting as a powerful drag, not just internally within China, but radiating outwards globally and profoundly impacting closely linked financial centers like Hong Kong.
So it really sounds like the world, not just Hong Kong or China, is still grappling with the profound lingering consequences of a series of past mistakes or misjudgments. You mentioned the initial pandemic lockdowns and their economic impact, the subsequent supply chain chaos, and then that really critical one, the incorrect belief that the global economy was on the road to a genuine recovery in 2021. We're basically still paying the price for getting that diagnosis wrong.
Precisely. And it wasn't just a few fringe analysts who got it wrong. As the source material emphasizes, very smart and very accomplished people fell for the price illusion. They genuinely mistook those high CPI inflation rates for signs of an overheating, booming economy that needed monetary tightening. But fundamentally, it was much more about a supply and demand imbalance occurring within a much lower, more vulnerable post-2008, post-pandemic economic state. The engine wasn't actually running hot, it was sputtering, and the gauges were faulty.
And instead of admitting the misdiagnosis,
And instead of quickly owning up to that fundamental misdiagnosis and maybe adjusting policy accordingly, the world, led by many central banks and governments, largely doubled down. They either continued extending and pretending the initial diagnosis wasn't a mistake, or for those who perhaps did grasp the truth sooner, they pinned their hopes on that mythical soft landing arriving in 2024 or 2025 to magically cover up the previous errors and allow for a painless adjustment.
but that soft landing didn't arrive.
But that hasn't happened either. The runway disappeared. The reality is this strategy of can-kicking, extend, and pretend is just getting harder and harder to do. The cracks in the foundation, to use that metaphor again, are becoming too wide and too obvious to just paint over anymore. And this is a fundamental lesson, a core takeaway, that applies far outside the Hong Kong city limits. This isn't just a regional banking issue. It's a global economic paradigm hitting a wall.
So if extend and pretend is getting harder, if the world is effectively running out of road to kick the can down, what does that ultimately imply for things like global interest rates and the broader economy? What's the potential reckoning, the end game for this paradigm?
Well, one key indicator that our source material highlights, something reflecting this growing stress in the financial plumbing, are interest rate swap spreads. Now, this gets a bit technical, but basically, these spreads are becoming more and more negative and getting lower and getting more negative.
Okay, what does a negative swap spread tell us simply?
In simple terms, a swap spread is the difference between the fixed interest rate on an interest rate swap agreement, often used by banks and corporations to manage interest rate risk, and the yield on a comparable government bond, like a U.S. Treasury bond. When these spreads turn significantly negative, it often signals a growing distrust or risk aversion within the banking system itself. It suggests financial institutions are increasingly demanding a premium for lending to each other or engaging in certain complex financial transactions compared to the perceived safety of just holding government debt.
So it's a fear gauge for banks.
It acts as a barometer of growing systemic fear and potentially a squeeze on bank balance sheet capacity or available high-quality collateral. This pattern, these increasingly negative swap spreads, signals that a true end to the global extend and pretend regime, meaning a real reckoning with bad debts and economic weakness, would likely bring market interest rates down a long ways, much lower than current levels, and keep them there for a long period of time. Because the true underlying demand for money and credit in a deleveraging, potentially deflationary global environment is probably much, much lower than the artificially maintained rates we've seen.
So the cleanup is still ahead of us.
Absolutely. The core message is there is still so much cleanup left to do, so many consequences to face, not just in Hong Kong or China, but basically everywhere. Everyone, from policymakers to investors to ordinary people, bought into the illusion of that price-driven recovery to some extent, and now the world still has to pay the price for all the mistakes. The pandemic responses, the lockdowns, the supply shocks, and crucially, the subsequent policy misdiagnoses. The global economy, which truly forgot how to grow in a healthy way, is now unfortunately remembering how to do worse, in part because that necessary, painful cleanup is finally being forced upon the system, whether policymakers actively choose it or not. Market forces and reality are asserting themselves.
Wow. This has been an incredibly insightful, if somewhat sobering, deep dive. It really feels like what's happening in Hong Kong serves as this stark, almost unavoidable cautionary tale. Not just for China, obviously, given their deep economic and financial ties, but really for the entire global economy. It's a vivid, real-time illustration of the profound consequences of delaying these fundamental economic adjustments, of kicking the can, of clinging to false hopes and narratives. That Goldilocks scenario, as you so aptly put it, seems definitively canceled.
Indeed. It feels like the true economic state we're uncovering is that the global economy forgot how to grow organically during that long period of artificial liquidity and manipulated interest rates, and is now, regrettably, remembering how to do worse. And this painful process, this downturn or stagnation or whatever form it takes, is, in a way, precisely because that necessary cleanup, the recognition of bad debts, the unwinding of malinvestments, the repricing of risk, is finally being forced upon us by reality. It's painful, yes, but it's also an absolutely necessary process if any kind of genuine, sustainable recovery is eventually to take hold down the road. You can't build a strong house on a rotten foundation.
So, as you, our listener, reflect on everything we've discussed today, this widespread extend and pretend paradigm, the canceled soft landing, the underlying economic weakness masked by illusions, we want to leave you with a provocative thought. What does all this mean for your personal financial planning? How might it influence your career outlook or the types of investments you're considering for the future? Are you perhaps even unknowingly building your own plans on the assumption of a soft landing that's already been canceled? Are you relying on a narrative that the unfolding reality seems to starkly contradict? Or are you actively preparing, mentally and financially, for the reality of the cleanup, the reckoning that seems to be finally being forced upon the global financial system? That's something important to mull over, perhaps to reevaluate your own assumptions in light of these profound global shifts we've explored today. This deep dive into Hong Kong's banking system has, we really hope, offered you a crucial shortcut, a lens, to understand some of the most pressing global economic trends that are simmering just beneath the surface of the daily headlines. Hope it was useful. If you found this deep dive valuable, if you enjoyed gaining these insights, please Do make sure to follow, like, and maybe share this deep dive with others out there who you think are curious about the real story behind the news.
Yeah, spreading the word helps us keep doing these.
Absolutely. And for more in-depth analysis and just to stay on top of these complex, fast-moving global developments, be sure to follow What Bitcoin Taught Me on all the platforms. Twitter X, Nostr, Bluesky, Threads, Instagram, Facebook, and LinkedIn. We try to cover all the bases.
We do.
Thanks so much for joining us today, and we'll see you on the next deep dive.